Hello and welcome to The Upside. I'm Kyle Cheropita. U.S. tariffs and global trade continue to dominate headlines this month, with Canadian and U.S. markets experiencing slight gains. On today's episode of The Upside, we'll be looking back at July's top stories and market highlights by counting down the top 5 highlights from our FidelityConnects webcast. Connects is live daily for financial professionals and then available on replay for all as a video podcast. And you're here, so you know that The Upside is our public webcast and podcast where you can learn to be a better investor and hear from some of Canada's best stock pickers and leading financial experts. Thanks for joining me today. To get us started, Bitcoin soared to record highs in July. Overall, the digital assets market continues to experience significant growth and evolution, driven by increased institutional adoption, key regulatory developments, and product innovation. Here, with more on Bitcoin, altcoins, and more, is Chris Kuiper, Vice President of Research at Fidelity Digital Assets, who joined us from Washington, D.C.
Bitcoin is probably the most well-known. It's got that brand name for everyone. It was the very first cryptocurrency, and the one that's still by far the largest, at least 60 to 70% of the entire crypto market cap, depending on how you want to count it. But we've got other things too. We've got an entire bucket of tokenized things, the largest of which are stablecoins, which I'm sure we'll talk about today. That's over $250 billion now. And then you've got all the other tokens besides Bitcoin. Some people call these altcoins, but they've been seeing a lot of recent interesting developments, a lot of price action as well. Ethereum, or the Ether token, is the second largest one right behind Bitcoin. And you have a number of them after that as well. So people are looking, like you said, at beyond Bitcoin, wanting to understand the space more fully. So hopefully we can answer some of those questions.
Let's go ahead and do that. And let's talk a little bit about the regulatory framework, which has now been codified in the United States. It was a big week. I think a lot of people heard about the Genius Act. Let's talk about that first. There are more, though, to the regulatory story. But let's begin with the significance, really, of the Genius Act, what it allows, sort of open the floodgates for.
Sure. So this one was recently passed, signed into law by President Trump just this week. It's called the Genius Act. Really think of it like a stablecoin act. That is almost its entire purpose. It's really focused on stablecoins, which we just mentioned. For those who may not be familiar, these are tokens that are backed by usually US dollars and usually 1-to-1. So people send in their dollars, these stablecoins are minted. And what that gives you is it gives you a something to transact in that's stable, that doesn't change versus the dollar like Bitcoin. So people who want to do trades, who want to make remittances or payments, will often use these stable coins. And it really is one of what we say the killer app use case of these crypto networks. Stable coins have found a really good product market fit. But for a while, there was a lot of regulatory uncertainty. So this Genius Act that just got passed hopefully removes a lot of that. What it does, in a nutshell, is it really gives some guidelines, clear guidelines as to who can issue these stable coins. It's very narrow. Not anyone can do it. They have to be backed 1-to-1 by US dollars, and they have to be backed by either cash or very conservative cash-like instruments like US treasuries. So again, a lot more clarity. There's more in it that we probably won't get into the weeds, but hopefully that gives you a good understanding there.
No, that's really helpful. So who can issue stablecoins then?
So it's big financial institutions and banks. Again, I would have to look back at all the very specifics, but it's meant to be so of these larger institutions that are well regulated, already regulated under certain things like banking or the Fed or FDIC or whomever it is are issuing these, not just anyone on the street, if you will.
And to the best of your ability, can you explain the difference between Bitcoin and Ethereum? Because Ethereum is something that it does sound like we're going to be talking an awful lot more about.
Yeah, it's a great question we get a lot and something investors really need to understand. Ethereum, originally when it was invented, a lot of the developers and people were working and writing about Bitcoin. And then they realized this Bitcoin network is really interesting, but I think we can do more by making a different one that's more programmable. And this way, it doesn't just become a monetary good in a payment network. It actually becomes this entire computing platform that you can build these decentralized apps on. That's what Ethereum seeks to do. And it's made itself very different from Bitcoin, which I think is a good thing because these things are very different in my opinion. They serve different use cases. And I think investors need to think of them with a different investment lens. So we're big advocates on the research side of looking at Bitcoin as an alternative monetary good, alternative commodity, an aspiring store of value, because the whole value proposition is there's a fixed limit, 21 million Bitcoin, that will ever exist. And it has all the properties of potentially being a great monetary good, something that you use to store value and make payments in. Ethereum, on the other hand, again, different use case. It's to drive and host these decentralized applications. A lot of decentralized finance stuff is done on Ethereum. Stable coins are, I think, around 30% of all of Ethereum's transactions. Wow. So a lot of people are getting excited about Ethereum with the rise of stable coins. And so that's why you have to think of two different things and the difference between them.
So clip number 4, building off of the digital assets discussion, alternative investments widen the scope of strategies available to investors beyond long-only investing. As a result of these funds' additional flexibility to utilize certain investment techniques compared to conventional mutual funds. In July, Rory Poole, Director of Alternatives, sat down with host Pamela Ritchie to discuss. Take a look.
Let's begin with just the example of today. So the jobs data comes in. The question, of course, is whether rates do or don't get cut by the Fed. What does this mean? It's a discussion. It's a live discussion. Take us to where this type of volatility and anything else can be perhaps just better balanced in a portfolio with an alternative fund. And I'm kind of looking at this as if it fits on the bond side of a 60-40. Just tell us a bit about that. We might talk about it.
Yeah, there's a few pieces we can probably unpack there, but getting directly to the first point that you mentioned with regards to like the bond market and the jobs number this morning and how those things are potentially related. I think that we had a strong print this morning, and as a result of that, I think the market would assume that we probably won't get a rate cut in the US for at least the summer. It'll probably push it into the fall, at which point I believe, as of most recent, they're pricing in about 2 rate cuts before the end of the year. Whether we get that or not, who knows? That's obviously going to impact performance within the bond market. As a result of that, yields this morning have crept up a little bit. But kind of layering in the whole where does an alternative fit or why now or some collection of all of those things. On top of that, you also have the fact that like equities in a lot of places that you look are suddenly like wake up, it's whatever, July, and they're back at all-time highs again. Yeah. And so I think that if you think about it in that way, in terms of the two major pieces of most people's portfolios, you layer on top of that the fact that we're going through all of this like continued political turmoil, some geopolitical tensions that are occurring. Like, if you want a way to potentially drown out a little bit of that noise within a certain pocket of your portfolio, whether that is the bond portion or the equity portion or some combination of the two, alternatives are certainly a great place for people to look.
And why are they? Like, what is it there that they are providing? So in a lot of cases, they have the ability to do short selling, the ability to go longer with maybe more conviction. Just take the pieces there apart for us, why this can help.
Yeah, well, the investment universe is huge. And it depends. Like, you're referring to more specifically like the liquid alternative market, which what I call kind of like hedge fund light type products. So within our lineup, that's the Dave Way long short alternatives, that's the Brett DeLay market neutrals, the Dan DuPont global value long shorts, the Ritu Kumra Canadian long short alternatives. And essentially what they do is they still use liquid underlying securities within the portfolio, but that they have these additional bells and whistles from a toolkit or portfolio management standpoint, where they can either increase the potential to generate return within the portfolio or have additional mechanisms as to which they can actually preserve capital further. So it's really just these additional measures that allow these products to take on a little bit of a different type of behavior potentially in certain market environments. And I think that if we rewind a couple of months ago to the drawdown that was experienced within really all equity markets from whatever was February until kind of beginning mid-April. If you look at the liquid alternative market, so we're just talking about these funds that use liquid underlying, you probably had 90+% of those funds outperforming the market over that drawdown period, and in some cases to a significant degree, and in other cases to a degree where they're actually generating return in a period where the market is falling at a pretty rapid rate. And so that kind of speaks to the whole argument, evergreen argument within alternatives of diversification and so forth. And then if you look at what I would call the other part of the alternatives market, at least through the lens of different types of investors, is what most institutional investors think of first and foremost, which are illiquid assets. And those really don't have any kind of first order impacts or any first order sensitivity to what we experienced in the first part of the year.
So there's sort of degrees of diversification, just even speaking broadly about liquid versus illiquid or less liquid within that. So it can provide diversity for you in a falling market, for instance, but also just due to the fact that it doesn't have to be priced daily, for instance, in something that's more
in some
illiquid.
cases, definitely with the illiquid stuff. There's a lot of empirical and academic evidence of the fact that valuing these assets, whether you agree with it or not, on a little bit of a less frequent cadence, that can result in less volatility within your portfolio over time. Like if you think about it, even if you're an equity manager, let's say, and instead of having your portfolio valued on a daily or intraday basis, which there's a lot of pros with doing that as well, but let's say for example that you were to value it on a monthly basis, and so you were to kind of drown out all of the performance that occurs in between, that may create a very different perception from an investor depending on what happens during the 1st and the 31st of the month, and how they view that investment or asset within their portfolio, and potentially how it works either in tandem or as a complementary piece to those other assets.
So if you want to hear more from Rory and the fascinating topic of alternatives, keep an eye on your inbox for news on upcoming webcasts. Rory will be on again in mid-August. Next up, clip number 3 features portfolio manager Don Newman. Don, quote, places high value on the quality of a company, its ability to generate free cash flow, and the strength of its balance sheet. Don manages Fidelity Dividend Fund and Dividend Plus Fund, and in his early July Connect show, he commented on how a dividend strategy can weather the market vol like we've seen this year.
I think this is just a really good, the last sort of 6 months or so, we've had so much volatility, and it's really given investors a reason to sort of revisit and sort of just reaffirm why you do invest in dividends. And I think we were talking about a little bit earlier, there was a point this year, S&P 500 had gone from like a little up to down 20, which would put a lot of stress on a lot of people. And unfortunately, there's a lot of people that may have made I can't take this anymore, the volatility is too much, I'm out. And then we had a 2-hour stretch where the U.S. administration decided to say, hey, actually, we're pulling back on the tariffs, market's up 10%, which is a year's return in about 2 hours. So the volatility has been huge. The nice thing is about the dividend strategy, the volatility hasn't been that big, and especially, Canada this year has actually been sort of a little bit of a bastion of stability. At the worst point of the year, I think the dividend fund was down close to 7%. It's now sort of up between 8 and 9.
Like when markets were down 20?
Yeah, when the markets were down 20. So there wasn't the need to be calling up an investment advisor saying, oh my gosh, I feel like I'm losing on one. Down 6 or 7, people can handle. So it's like the stability, the yield, the companies that are not, going from 40 times earnings down to 25, you're already sitting at 15 times earnings. That's a pretty reasonable number. So less volatility there. My pitch to investors and investment advisors that I always come to is just, the biggest mistakes are made when you get really excited at the top and you get really depressed at the bottom. You buy at the top, you sell at the bottom, you lose a lot of money. The idea is keep invested in a good strategy with maybe a little, and what I try to do with my funds, a little bit less volatility over the time. So I always try, it's like good company, reasonable prices, maintain and grow dividends over time. And because you've got a little bit less volatility, you hold on longer, you get the power of compounding, and you look back in 5 or 10 years and you've done really well with a little less stress.
Yeah, holy smokes. Yeah, because that was really quite something, I think, for a lot of investors to hold on, as you say. That's when mistakes are made. Yeah.
Yeah.
So when we think about sort of this macro data roller coaster, which it has been, because we're now sort of sitting
Completely.
on the cusp of earnings for the second quarter, and we're wondering what the tariff story is going to mean and where we're going to see it and so on. Have the sectors that you look at, the companies that you're in contact with all the time, have they gone to this sort of we've passed peak tariff concern? What it feels like people are leaders of companies are actually speaking a bit more.
Yeah, well, I think what the big sort of concern was with the tariffs. One, the big numbers that were going to be put out on tariffs, and hopefully that's been scaled back a little bit at this point. But the other big concern was just like you create uncertainty, and I always like to say like the market can deal with good. The market can deal with bad. The market really hates uncertainty. CEOs hate uncertainty. If they don't know what to do, what ends up happening is they say, you go into conversations, what are you doing? Pencils are down right now. We're not sure what we're doing. If pencils are down, that means investment's not going into the system. That means you're not getting, companies aren't investing in productive resources that can help grow their earnings over time. And it's not good for corporate profits. I think what we're seeing, and we're hearing at least from some of the banks when we're talking to them, is things are slow, but conversations are starting again. And there's some green shoots out there where companies are saying, okay, we're a little more comfortable with the operating environment. We still got to see, there's U.S. administration tends to flip-flop a fair bit. But we've got to start thinking about sort of investing and doing the right things for our stockholders and our company. And we're starting to sort of the idea of like, okay, we've got a little bit of better feel. Things seem to be a little more under control, and we can start talking about actual doing projects and putting CapEx in the ground again.
For clip number 2 today, we're focusing on the intriguing materials sector with equity research analyst Claire Fleming, speaking with host Pamela Ritchie about nuclear energy, uranium, copper, and more.
There are many headlines about lots of different things in the world, but there's no question that nuclear is one of the big ones. This ties into uranium for you, but I wonder if you can just paint us a little bit of a picture of, it seems like tectonic shifts for this once mothballed industry in a lot of different ways. Tell us how everything has changed in the last however many months, 6 months.
I think it's been a really interesting time to be covering the sector, just because there has been so much change over the past even few months, and especially few years for the industry. I think what we've been seeing is that you've seen continued announcements related to new reactors in China as a source of generation for their grid, but for the first time in a long time, you're starting to see more discussion around new reactors in Western countries as well, especially with more recently some of the executive orders coming out of the US, starting to look more at the opportunities to be adding new reactors to the fleet. So I think that creates a lot of potential opportunities and change across that value chain, ranging from the upstream commodities like uranium that I look at more closely, to companies involved with all the steps along that you need to support a reactor, from converting that uranium once it comes into the mine and enriching it and fabricating it into those little bundles the reactors need, or the parts that go into building those reactors and maintaining them. So there's a lot of collaboration from myself to working with the power and utilities analysts and the industrials analysts to help portfolio managers understand like what these announcements could mean for the longer term earnings and valuation of the companies that we're researching, and helping them to find the best opportunities across those different areas of the value chain within the industry.
It's so interesting. I wonder if you could speak to if there are a lot of opportunities to invest across the value chain. We can pick on nuclear for a second, but it may be a broader story of, it seems like a lot of different pieces of the story of nuclear are actually government owned. So I don't know how investment dollars flow. How do you, maybe that bids up other things, but tell us sort of the dynamics of what's available to invest in within this story.
And I think this is an industry where you do have some of that scarcity value for companies, just because, as you mentioned, especially in certain parts of the world, a lot of areas of this value chain are more government owned for national security reasons, or private companies involved in the value chain, which really reduces that potential opportunity set that you have to get exposure to this in a public equities portfolio. So I think some of that scarcity value has been contributing to the increase in valuation multiples that we've seen across this industry. So that is definitely a factor that comes into consideration when PMs are thinking about what the right valuation for these types of companies are.
That's so interesting. And you mentioned so that portfolio managers obviously can get a longer term view. It is a long term view, right? I mean, nuclear reactors are not going to be, the new ones that they're being discussed are not going to be ready in 2 years. Mm-hmm. This is a much longer term story.
It is a very long duration story for nuclear, but I think what's interesting is that the demand outlook compared to other areas of my coverage group that can be more cyclical or have more variability, at least that existing reactor base gives you visibility on what that base demand growth outlook could be. And no matter the tariff scenario or other factors, you at least have more visibility on what that demand could be. And then these additional reactor announcements become potential sources of optionality, and that can tie into sort of what that longer term uranium price could be if you do get these additional capacity investments going through. So I think that even though this is a very long duration theme, I think that's what's great about like building your financial models and scenarios, that you can understand how that impacts the long-term supply demand picture and what sort of that multi-year outlook as well, if they're not involved necessarily in the upstream commodity, also if there are companies that could be involved in the sort of early work and studies that would go into these new reactors, or supplying the parts.
Right,
or as you mentioned, there's companies that can even get an upfront like payment for using their technology as that IP payment over that reactor life. So there's a lot of ways that companies can benefit from this trend, even though the duration of those impacts can vary based on what area of the value chain they're in.
Oh my gosh, it's fascinating that you're digging into this on behalf of everyone at Fidelity. It is a fascinating time. Let's talk a little bit about the story for copper. So in January, before January, sort of even into February, all we heard was just every cargo ship that could be filled with copper was hitting the U.S. shores before tariffs that they knew were coming hit. And then, there's this massive pull forward story. Is that still the case? That's still very much in the markets pricing right now?
I think it is interesting to see some of the impacts or dislocations that you've gotten in global pricing benchmarks, just given some of the potential outcomes for tariffs. As you mentioned, just given speculation that the ongoing Section 232 investigation and other factors in U.S. policy could potentially lead to a tariff being implemented for copper. And I think that investigation is similar to what you would have even seen for steel or aluminum in the first Trump administration as a potential tariff really to help protect and incentivize domestic supply of certain commodities for various reasons, but some could also relate to national security. So even though nothing's been announced yet, that investigation's ongoing, you've started to see U.S. prices for copper trading at a premium to global benchmarks, just because there's a view that tariffs could be implemented, which is creating some interesting dislocations, as you mentioned, given that traders are sending copper over on ships, thinking that they could benefit from getting that material into the U.S. ahead of any potential tariffs. But then that started to tighten up some of the global pricing benchmarks this year, just because as that material goes to the US and some of it is a bit stockpiled until we get clarity on what tariff rates could be, you're starting to see other global exchanges tighten on inventory, which has contributed to higher global pricing benchmarks. So I think that could be a bit of a shorter term risk, of course, depending on what tariff rate gets announced or how that investigation concludes, because if you do have visibility, that could start to disincentivize that material from continuing to flow to the US and help bring some of those global exchanges into more balance, and also could sort of reduce the incentive to stockpile some of that material in the US and work through some of that inventory that's been building in the US year to date.
And our number one final clip today features Jurrien Timmer, Director of Global Macro. Jurrien joins Connects every Monday to share his thoughts on markets, all complemented by his amazing charts and data. His show is often featured as Tuesday's Upside webcast, and of course with a Connects video podcast replay also available. Here he is with what's on his mind as we wrap up July.
So if you look at what the markets are doing, the stock market is making modest new highs. The Mag 7 continues to power along. Global markets are very much participating in this, which is great to see because it really shows, like you said, a bigger pond that we can all fish in is obviously better than the last 10 years where, it was a very binary choice that if you were in this space that worked, then great. But if you were not, you were really left behind. And that's no longer really the case. But we're starting to get some animal spirits back. If we go to slide 7, the non-profitable tech stocks, these were the darlings of the 2021 liquidity bubble. Remember when we had COVID and we had all that fiscal helicopter money that the Fed was essentially monetizing, and then it stayed too accommodative for too long. That created a liquidity bubble, and we had the whole meme stock frenzy. That, of course, unraveled as they always do when rates go up. And for the last few years, those stocks have just been sitting at the bottom, down 50%, but they're starting to stir a little bit. And so, whether that's complacency or not, I'll leave to everyone to conclude for themselves. But when you look at the two elephants in the room, they're still there, right? One is tariffs, and one is the fiscal side with bond yields possibly, pushing up towards 4.5 and 5 again in the future. Those two risks have not gone away. I think the market is just concluding that, whatever, we'll believe it when we see it in terms of the tariff stuff, because we've had so many back and forths on, threats and then supposedly deals and this and that. So I think the market has kind of gone from pricing a left tail to back to pricing a right tail, driven by the big, beautiful bill. And in the meantime, the earnings story, which earnings got marked down right back in April, if we go to slide 4, they are getting unmarked now because the worst case scenario for tariffs has not yet materialized. Maybe it still will, but earnings growth estimates got marked down by about 400 or 500 basis points back in April. And now we have the big, beautiful bill. We have tailwinds from a lower dollar, which tends to boost earnings for U.S. large cap companies. And what we're seeing is that earnings season, which is now a week underway, is already seeing the customary bounce. The growth rate for Q2 earnings coming into earnings season was 2.5%. We're now at 3.8 or so, and that is very likely to continue in the next few weeks. So the earnings story is good. And if we go to slide 3, the valuation story, we're back to valuations amplifying earnings rather than offsetting them, right? So we've talked about this in the past. 2023 and 2024, we saw a big lift from valuations. And then, of course, earlier this year, we saw the opposite. And that was always my sense, is that, this would be a more two-sided year where earnings would grow, but valuations would compress. Right now, and it's just a snapshot in time right now, we have valuations up about 8% year over year, earnings about 10 or so or 8, and then dividends is 1, and so you get a pretty good performance profile. But again, we're only halfway through the year, and again, those elephants have not left the room yet.
I hope you enjoyed all of those clips. Thank you for joining me on today's show. Again, you can find a full 30-minute video podcast of each of those clips available on YouTube, Spotify, Apple Podcasts, and more. At Fidelity Investments Canada, we're putting out fresh content daily, so please look up the FidelityConnects or recently launched Upside podcast for more. I'm sure there is a topic there for everyone. And as always, for more from us, please follow Fidelity Canada on LinkedIn, YouTube, or Instagram. Thanks for watching today, and I hope you'll join us again on the Upside. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.